posting a degrowth of 53% during the quarter, and 156 crores against 191 crore, posting degrowth of 18% for 9 months. As I have expressed before, institution business is more unpredictable and lumpy in nature, and it can have high variability from quarter to quarter. With this, now I hand over to Mr. Rajesh Agrawal, our Joint Managing Director, who will take you through India business. Thank you, and over to you, Rajesh.
Thank you very much. Good evening to all of you. Let me discuss some of the key highlights of the India business with you now. India business contributed 30% to the overall revenue of the group. Sales for India business stood at 260 crores as against 220 crore rupees, posting a healthy growth of 18% during the quarter. And it stood at 737 crore against rupees 595 crores, posting a healthy growth of 24% during the first 9 months of FY 2022. This includes sales from trade generic of rupees 30 crores during the quarter and of rupees 87 crores in the first 9 months of FY 22. Our performance has been satisfactory, which was on the back of new product launches, market share gain, and also price increase. As per IQVIA MAT December 2021, we have posted healthy growth in all the therapeutic segments and exceeded the industry growth rates across therapies. We have launched 16 new products in the first 9 months of FY22 with 4 first-to-market products. Field activities and its expenses are normalized and back to pre-COVID levels. With this, I now hand over to Arvind Agrawal, CFO, to take you through the financial performance. Thank you, and over to you, Arvind.
Thank you very much, sir. Good evening to all of you, and warm welcome to this earnings call. For ease of discussion, we will look at the consolidated financials and provide year-on-year comparison. Let me share key highlights with you. It was an excellent quarter with 12% growth in revenue at rupees 838 crores against 749 crores. During 9 months FY22, revenue was 2,471 crores against 2,133 crores, a growth of 16%. EBITDA for the quarter stood at 240 crores against rupees 242 crores for 9 months. It was at rupees 731 crores against rupees 739 crores. EBITDA was 29% in Q3 and 30% in 9 months of revenue from operations and saw marginal degrowth. The impact was due to 2 aspects. One was the normalized expenses on both R&D and marketing, and also increase in input costs and freight expenses. These are the 2 major things which have really impacted our EBITDA margin, which we have already talked about. During the quarter, PAT was at rupees 192 crores against rupees 177 crores, up 9%. And in 9 months, it stood at 561 crores against rupees 495 crores, up 14%. PAT was 23% of revenue from operations. Material cost was in line with our expectations. However, we continue to see the material prices going up as a result of global inflation. R&D expenses was at rupees 51 crores against rupees 40 crores for the quarter and rupees 145 crores against rupees 100 crores for 9 months of FY22. R&D expenses stood at 6% of revenue, which was in line with our pre-COVID level. Other expenses have reached normal level as all the activities are at pre-COVID level now. Other income stood at rupees 78 crores in 9 months of FY22, mainly contributed by forex gains of rupees 49 crores. Income tax stood at 21% in 9 months of FY22 against 27% in FY2021 and expected to be around this level for the year. We incurred capex of rupees 116 crores in 9 months of FY 2022 against full year projection of about rupees 200 crores. With these highlights, I open the floor for the question and answer. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Anyone who has a question may enter star and one. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take the first question from the line of Tushar Malpani from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity. So just a clarification on other expenses wherein the freight costs were continued to be at higher level, but then the activities are back to pre-COVID level. So 250 crores on a quarterly basis, is that a steady rate to go with, or there could be further changes into on an absolute basis?
I think on absolute basis, we can consider the rate of about same 250 level. 247 is the current amount, so 250 level should be the normal level. Okay. So then, I mean, from 230 levels to about 247 on a sequential basis. Yes.
Is the increase that has happened?
Yes. Yes.
And secondly, on the US sales, with the slowing of filing as well as launches, do you see further price erosion impacting to what level basically on the US sales run rate?
So, good question, but unfortunately, very difficult to make any predictions on that. So we've seen some aggressive price erosions in last 9 months. We believe that they should stabilize at some point in time. But the question is when and how much is yet to be determined. So very difficult to point a finger on that number there.
Okay, sir. And like, how many approvals do you expect, let's say, in next 3 to 6 months?
Again, very difficult. We have number of ANDAs awaiting approval, awaiting the facility inspection. So we have the complete response from the FDA saying that once the facility approval, they'll come for the facility approval and then approve the ANDA. So a bit unpredictable right now when they'll start the complete inspections and start giving the approvals.
Understood.
Yes.
And just lastly, what could be the outlook on the institutional anti-malaria business in terms of order book?
Institution is again bit choppy. Current scenario we've seen, I think the funds, global funds, the funds are not that much with the agencies. The countries are not donating as much. So difficult to put a number there. It's I think already we've seen in this quarter there's a significant drop, but we've been able to recover that loss with some other businesses from India and the emerging markets branded generic.
Right.
Yeah.
Okay, sir. That helps. Thank you.
Yeah.
Thank you.
Thank you. Any participant with a question may enter star and one. Our next question is from the line of Abdul Qadir Puranwala from Elara Capital. Please go ahead.
Yeah, hi sir. Thank you for the opportunity. So would it be possible for you to break your India growth in volume, price and launches?
I think, yes, we can do that. Maybe at some point, if you can get in touch with the investor relations team, CFO can share the information with you.
Sure.
Detailed manner, yeah.
Sure. And so in terms of the launches, so far you said you have launched close to 16 products. So what is the target for this year and for next year in terms of launches? And which therapies should we expect these launches to be?
So we don't have a target specifically set for every year. We take it as it comes. For the current year, I think more or less whatever brands we had to launch, we have launched them already into the market. There may be a couple of more which may get launched between Jan and March. And as of now, as it stands, it's mostly into cardiology, anti-diabetic, segments that we have introduced, and there have been some products which we brought in, which have been to plug the gap in the therapy areas in which we operate.
Got it. And so just lastly, on the tax rate front, I slightly missed the remarks of Arvindji. So, would the tax rate remain at 17% or the 9-month level of 27%?
Around 21%. Because 9 months, if you see, is about 21%. So we are expecting that rate to be there for the whole year.
All right, sir. Got it. Thank you so much.
Thank you.
Thank you. Our next question is from the line of Nakshita Mehta from Credent Asset Management. Please go ahead.
Hi, good evening, and thank you, for taking my question. So I see you've come up with a buyback, right? So I just wanted to know what are our plans with that capital? Are we planning some kind of capex, and what is it? If you can just give some light on that.
No, because we don't need that particular money now, and that is why we have announced the buyback. So it is something which we are giving back to the shareholders. So practically we are not raising the money, we are repaying back to the shareholders.
Correct. Sorry, I got confused. But even so, is there any capex or any thing that we are coming up with?
See, this year we have given the guidance of about 200 crore capex, which is happening as we go along. And from next year onwards, we have given the guidance that about maintenance capex will be there of about 150 crores.
Okay. So this capex would be in terms of in India, or it would be overseas? How is it?
It will be only in India.
Okay, only in India. All right.
Yeah.
Okay, thank you.
Thank you.
Thank you. Our next question is from the line of Ranveer Singh from Sunidhi Securities. Please go ahead.
Thanks for taking my question. So just a few clarity here on India business. Currently we have 2,800 field force. Earlier it used to be 3,000. So have we curtailed 200 field force?
Yes. In fact, during the COVID level, there were some of the people which were in Q1, if you remember, we have said that we have, reduced the numbers by about 200.
So current sales productivity has obviously sequentially I see a good improvement there.
Yes.
So is this sustainable, or can we expect this going further up?
It can go up further.
But
Sorry, yeah, please go ahead.
I'm sorry. You would like to
please go ahead. No, please go ahead. You can
practically the normal growth which we are expecting in the India market, that will remain. We are not expecting any major addition to the field force in India.
And just to add to that, and the whole objective is to increase the productivity, and we are not looking at further optimizing the field strength. I think this is an ideal number, and we will build on the productivity for the next whole year.
Okay. And another aspect I see of that 4 major portfolio, pain management has been growing, strongly for last few quarters. So is there deliberate strategy to focus on, or is this a market itself is driving this segment?
This is a deliberate strategy. This segment we have been operating for a few years now, and we have very good products with us at this point. And we are the market leaders in those, including Febuxostat, which itself is over a 50 crore brand for us at this point. So that also is growing in a double-digit growth rate.
So can you give some guidance or something, just a ballpark that where pain management segment is going to be in terms of percentage of sales going forward, let's say for 2-3 years?
Honestly, again, it depends. It's not a specific target that we take, in the sense that to the domestic business, we want pain to contribute X percentage versus cardiology versus ophthalmology. It will primarily be dependent on what opportunities we get in hand and how we can maintain the market leadership. But pain is a very important therapeutic segment for us. And we have a very strong presence in each of the molecules that we have in the brand portfolio. We are the market leadership positions in those.
Okay, fine. So, last one, with your permission, in U.S. business, the filing has been stagnant, and now in Q4, everything is looking like bunching up out of 10 target filing. So, was there any challenges there in filing, or that was already scheduled for Q4, which earlier we guided?
No, it just happened to be that way. When we kick-started the R&D after the lockdown, it took little time to get the momentum back. So by the time we got the momentum back and all the activities started, the bioequivalence, the pilot bioequivalence and all those things, it just so happened that the bunching is happening in the Q4. But this is 1 year where this bunching is happening. Next year onwards, we feel the filings would be more spread out during the whole year, because now we've got all the momentum in place now. So there are a lot of products which are at an advanced stage of development, manufacturing, maybe taking exhibit batches and things like that. So next year we should see the more evened out kind of filings.
And any indication on number of launches in FY23 or in Q4?
So, I don't think you'll get that answer from anyone with a convincing way. When I say anyone, is any pharma company, because as I shared earlier with the earlier caller, it's very unpredictable because of the inspection primarily.
Okay.
So once the inspection opens up, you can expect a good number of launches to come through, because the approvals will then just line up. And 2 of our facilities are USFDA approved. So even if they come to one facility, there are a number of ANDAs from each facility which are awaiting. So once that inspection happens, then hopefully a number of ANDAs will get cleared. So right now it is more of a wait and watch kind of scenario.
No, but we already have a few products which are approved but not launched. So of that 41, 42 approvals.
There are some tentative approvals, which is available in the public domain also. Some of them are there. Some we are expecting approvals in maybe Q3, Q4 or Q1.
Okay, that's it on my side. Thanks.
Yeah, sure.
Thank you. We'll take a next question from the line of Aditya Khemka from InCred Asset Management. Please go ahead.
Yeah, hi. Thanks for the opportunity. So, firstly, on the India portfolio, could you inform us how much of our portfolio is under NLEM?
Yes, so we know.
15%.
15%. Did I hear you right?
Yeah.
Okay. And then my next question is that, given that this time WPI is north of 10% and, likely the government will allow you to take anything up to 10% price increase in your NLEM portfolio, and your costs have also gone up because API prices have gone up and contract manufacturers must be asking for a higher price for the product. What kind of price increase do you think you can take in FY22, given that WPI will be north of 10%?
Surely. So WPI stands at maybe 10.4 odd at this point. And so you, I think, in a way have answered your own question. Like we would look to maximize the price increase that's permitted by the government authority. So that would be again 10% odd. Because if you look at the past, even though now it may look 10% plus, but if you look at the past 2 years, it's also been in very low single digit. You would remember last year was something like maybe a year before last was 0.5%. So there's been accumulated pain in the industry, I suppose, and so we would look to maximize it.
Right. So would that imply like a 9-10% price growth across the portfolio, NLEM and non-NLEM?
I think NLEM for sure. Non-NLEM is very competitive and market scenario based. We cannot be much higher than the other competitors. But when it comes to NLEM, as you would have seen, all the market leaders have similar pricing, which is pegging the NLEM permitted price. So in that case, yes, we should be looking at increasing it 10%. There is a bit of a confusion at this point because NPPA mandates that we cannot increase more than 10%, whereas the WPI has arrived at 10.5%. So we would really need to tread that carefully and see because we don't want to get caught in the crossfire there.
Yeah, I think NLEM mentions WPI or 10%, whichever is lower. So I think
so there you go. So that's what it is. We just want to be very careful. We will work it out through some of the consultants and only then move ahead.
Understood. And again, just to reiterate, we'll do it on your NLEM and non-NLEM portfolio, but non-NLEM will be also driven by competitive forces.
That is correct.
Understood. So what is the impact on the gross margin we are seeing because of inflation of this raw material? Are you already experiencing some impact on gross margins because of this?
Yeah, we are experiencing, and that is already factored in. So the number which you see for the current quarter is, we are not giving the breakup in each head on what is the increase on the freight or the raw materials and the price erosion. But there have been impact which has adversely, but fortunately we've been able to mitigate that with our branded generic business, which is in India and emerging market, which is a higher margin. But we have seen all these two components impacting our gross contributions and gross margins. If it wasn't for these, then I think our performance would have been even slightly better than what it is now.
Right. And so India, obviously, we know the regulatory framework and we understand how you can increase prices and how much you can increase prices. Can you help us understand the regulatory framework, if at all, on the emerging market side, where you have other branded generics basically? In those markets, how does it work with price increases? How easy it is to pass on inflation and cost, or how difficult it is? If you can just talk about that a little bit.
So different markets, they have different regulations. Just to simplify for you and all the callers, I would say around 60% to 65% of the countries where we have businesses, they have a price control, so the prices are fixed. And about 40%, let's say 35 to 40%, we are free to price the product. We can do the changes in the price, increase or decrease them.
This is within the branded generic bucket, the export.
The branded generic bucket, yeah.
Understood. So wherever there is price fixing by the government, will they take into account the inflation and cost that you are facing, or is that something? What has been the trend so far? I mean, for the last 2-3 years, how has been the pricing moving in those markets?
Some countries, they agreed, they accepted that this inflation is a global phenomenon and freight and all the components are going up. So they have given some relaxation. But some countries, they have still not yet yielded to the request of the industry. So the efforts are on directly representation to the various authorities or to some bodies, associations and things like that. We feel that at some point in time, they will have to yield to some level. The question is when and how much. So we have to just wait and watch.
Right. And so one last question along the same line. How easy would it be or how difficult would it be to pass on this cost pressure in the US market?
That's a wishful thinking. In the US is very different. As you all know, it's very, very competitive. So I don't think the possibility of passing on the price increases in the US market exists. It's very driven by the competition. So I think that's the nature of the game which we're playing. We have to live with that.
So if I were to...
Only way you can do is try to increase your market share, but that also has its own risks. If you try to disrupt the apple cart, that can also sometimes not work in your favor.
Absolutely. Increasing volume means increasing capital employed and increasing capacity. So
yes.
That obviously is another different risk altogether. So if I were to sort the markets in terms of ease of passing on cost inflation, it would be India, followed by certain branded generic markets which have regulatory frameworks, which don't have regulatory frameworks, followed by certain branded markets which have a regulatory framework, followed by the US. Is that the order you would go with?
Yeah, absolutely. I think you got it perfectly in the correct order.
Understood. So this is very helpful. Just one question different from this, all of this. In terms of margins now in the US, would you still say you are at the corporate average, below the corporate average, above the corporate average?
What average?
Below the corporate average or
EBITDA margin?
No, we are not sharing those finer details. But overall, as we've shared in the last quarter, we are profitable at EBITDA and PAT level also in the US. So that doesn't change in this quarter as well. So we still are doing all right with our margins.
And sir, given where your profitability is now for the US and for the Indian market and for emerging markets, what is the best use of your capital? Would you want to increase capacity in US? Would you want to launch more products in India or launch more products in branded generic market exports?
Let me put it other way around. I think nothing has stopped us from launching more products or expanding in the branded generic business, whether it is in India or emerging markets. And we continue to remain very aggressive in all our markets. India, already Rajesh has shared with you. Emerging markets, you can see the growth which we have been posting in Africa and certain Asia and other territories. So they are very robust plans which we have there. And I have shared before also, US, we are trading very carefully because the investments are very high in the ANDA filing. So we have to be very judicious on the product selection, on how many products we are going to file. So we've already curtailed our ambition in the US for the ANDAs which we are going to file. Earlier we were expecting 15 to 18, which we have now dropped down to around 10 plus. So we are being very careful with the investments which we are making in the US. And in terms of capacity, if you say manufacturing capacity, we have adequate capacities for all our markets, whether it is India or branded generic emerging markets, or including US, whatever ANDAs which we are filing from both the facilities, as and when we get them to the launch, we have adequate capacities. So there is no particular capex which we are looking to add other than the routine maintenance capex for next 3 to 4 years at least, the visibility which we have in the existing business verticals. If we open up in a new vertical, that's a different ballgame.
Right. So, sir, in the foreseeable 3 to 5 years, do you see you putting more capital to work in the US? Barring the 8-10 ANDAs which you will file, do you see yourself allocating more capital to the US in the next 3 to 5 years?
No.
I ask this because the market isn't working out for you, right?
Sorry, what is not working out?
The economics of the market isn't working in our favor, right?
Exactly. So as I've told you, our more optimistic and more plans and this thing is in the branded generic business, whether it is India or emerging markets, and we are trading carefully in the US, being selective in the ANDA filing. So naturally, the capital allocation will be higher on these other markets, branded generic business as compared to the US.
Thank you so much for taking my questions. Thank you for being patient with me. Thank you.
Sure.
Thank you. The next question is from the line of Kunal Randeria from Edelweiss. Please go ahead.
Good evening, everyone. So, just trying to understand the US pricing pressure a bit more, especially with regards to Ajanta's portfolio. So, does it look higher because you have not had new launches this year, or has your base business erosion been much higher than what it was in the previous years?
I don't know if the higher is in relation to what. We don't have any figures from the competition. We just know generally what is in the price erosion, which is on the double digit. So, in fact, I would say that we have one of more insulated companies in the US business, what we have, as compared to some of our competitors, where their base business got more adversely impacted than us. So, we've done better. So we've done a decent job in protecting our market share. Maybe that was maybe at the cost of reduced margins. But in absolute amount, or let's say in the number of tablets, if you say, we've done a pretty good job of defending our business.
So, but would it be fair to say instead of 2 launches or 3 launches that you have done in 9 months, had you done 7-8 launches, the erosion would have been substantially lower?
Yeah. So in the US, the business growth is a direct function of the new product launches which you will get in the market. Because existing business, the scale-up can happen. It's not very predictable on how much market share you can increase. It depends on any competitor having supply challenges, constraints. We are able to make place for with that new customer there. And the new products are always the growth drivers. So that one major important growth driver for the US that was taken away from us. And we had to make do with whatever products we had, not only this thing, but we had to defend the existing business which we had. So once the new product launches comes in, hopefully next year, we should be able to start posting the growths in US again.
Sure. And just a follow-up on this, in 2018, 2019, you had seen a lot of the larger US-focused guys withdrawing some of the molecules in the US because they couldn't cope up with the price erosion because, it didn't make a lot of economic sense to be in the market. Have you started to see it in the market now?
No particular pattern emerges like that. There have been on and off people coming in and then going out. So I think if I try to guess, I would be speculating, which I don't want to do. But we haven't seen some major players declaring that, okay, we are going to exit from 50 ANDAs or 20 ANDAs or 100 ANDAs. Selectively, if it becomes unviable for them, they feel their capacities are better utilized for some other products, all those factors, then we've seen the people withdrawing the products from the market there.
Sure. And sir, just as a clarification, in the domestic business, has the trade generics contribution gone up?
You're saying the trade generic business?
Yes, certainly it has gone up. The trade generic business is growing, and therefore contribution is marginally going up. But as you would see, it's again a very, very small percent of the total business.
Sure. So just it means that branded is growing comfortably in low teens, right? That would be fair to assume.
No, branded is growing much more, as we've reported. It's growing in higher teens.
Okay, sure. And just one more question for Arvind ji. Sir, your employee cost has gone up around 20% on a year-on-year basis. If you could share some of the reasons behind it, and next year onwards, should we assume that it would be more like, high single digit, 10% kind of growth?
Yes, we have added some people in R&D and some other areas. So definitely this is because of that reason. And going forward, I think it should be normal because now we have almost filled all the vacancies which were there.
There was also some facilities which got added. Our Guwahati facility has been continuously operationalizing each line. So as and when the new blocks get added, but now they are all fully baked in. So what numbers you see, they are the normalized going number. And as you said, it should go into that increment percentage of yearly increments, what you should see from year onwards, from the next year onwards.
Sure. Got it. Yeah, thanks a lot for this.
If you already see, I think for the quarter-wise, you can see a trend. We are at a similar number of 160 crores plus minus for last 3 quarters. So you can already see a trend that it is already established, that the base is established around there.
Okay, got it. Thank you very much.
Sure.
Thank you. Our next question is from the line of Nitin Gosar from Invesco. Please go ahead.
Hi, thanks for the opportunity. Over last 3-4 years, if one were to see as a company, our rank is improving in IPM. But if one were to take a therapeutic specific call, cardiology is not showing a substantial improvement. In fact, cardiology is where we have given away a couple of ranks. What's your analysis? Is there any product gap, or are we not able to service the white space that we used to service earlier? How should we see this getting addressed going forward?
In cardiology, primarily what has happened is, if you look at the drop that you may see, is a bit deceptive. And if you look at it, that's happened in the last maybe less than 2 years. And that is primarily because there have been a lot of COVID-driven products in cardiovascular which have grown substantially in the last year. And in which antiplatelet therapies, right? Every COVID patient was being prescribed that after COVID recovery, antithrombosis. So you see, that is where the growth has come from. If I look at it in a more granular manner, in each subtherapeutic segment in which we are present, then I don't see a major market loss. There may be, couple of brands where we may be slightly growing lesser than the industry growth or the subtherapeutic segment growth. But all in all, it's not a major concern for us.
Okay, got it.
Sure.
And you did mention about domestic business X of generics growing at higher double digit. Would it be fair to assume that generic business would have been more like growing at 30-40% for us right now?
Quarter we had 17% growth. And so last quarter was 14% growth.
Last quarter was? 40
14%.
14.
Yeah, and the current quarter is 17%. This is for the trade generics I'm talking.
Got it.
Yeah. 9 months? Yeah. So 9 months is 33%, but last 2 quarters is what I've given the figures, 14% and 17%.
Fair point. Got it, sir.
Yeah.
Another question is with regard to capital allocation. I totally appreciate management's call to give back cash to the shareholders. But does it also mean that there are no adequate inorganic opportunities in India market, or are we not so eager to assess any of them for certain reasons?
No, we are very much interested and agile on that front. And as you know, I think India is one of the markets where these inorganic opportunities we would be interested in, because now US doesn't make sense to make those kind of capital allocation for that. But we haven't been able to get a compelling case where it makes sense for us to make. We didn't find any good quality assets so far. Let's put it that way, which has a good synergy with what businesses which we have.
Got it. And for this assets that we would have evaluated, how much bearing valuations would have on them to decide either way?
The valuations have a major role to play. It's all on what value you get it at, right? So, for example, if you're getting it at a much higher valuation than what one would expect, then that leaves zero room for any bad year or downside. And you're paying upfront 10-year worth of the business. So that's a bit scary for us. And that's one of the reasons why we have been very, very careful with proceeding forward with the inorganic opportunities in the domestic market.
Fair point. On the Asia branded business, I totally take the point. The growth over here has been fluctuating over a period of time. You tend to grow at a certain CAGR rate. But would you help us understand more in granular, which all countries you are seeing growth and which all countries you are currently witnessing certain degree of stagnation?
So we are not sharing those country-wise granular data, but overall blended basis, this is where it looks at, what the figures which you see.
Okay. And would the past 4-5 year history be good enough for us to go by, or there has been change in the growth aspect?
Yeah, I think that is something which definitely is the guideline, which you can certainly take it.
Okay. And one last question is on the margins outlook. In past, we have always said, as a company, we like to settle around 31, 32 if the assets were to operate at right utilization levels. At today's juncture, do we see any kind of material change in the outlook for the margin trajectory, or how should we see this?
We always talked about the margin level to be around the level which is existing today. If you see my 9 months margin, EBITDA margin, that is somewhere around 30%. So anything between around that is something which is definitely possible.
Okay.
Thank you. Our next question is from the line of Bhavesh Jain from Kotak Investments. Please go ahead. Mr. Bhavesh Jain, please go ahead with your question. There seems to be no response from this line. In the meanwhile, we'll take a next question from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the follow-up. Just on this NLEM-led price hike, just to understand, given the fragmented nature of industry, so will 10% will be kind of possible kind of a price hike, or you wait for the other players? How do they react and then accordingly take the call?
No, we would not wait for other players. As a matter of fact, honestly, I would be surprised if any of the leading companies, which are almost our size or larger than us, would not take the maximum permissible price rise in the NLEM brands. So in that sense, we would not be waiting. We would be putting it into effect in the month of April itself.
Interesting. So given that such kind of price hikes in NLEM and in which case non-NLEM also looks lucrative from the pricing perspective, but at the same time, given that we have a high base of FY21, so would we be still growing at a healthy double digit in India business next year?
Maybe it's a bit early to say. We would like to comment on this maybe start of the year, sometime in April, see how the next 3 months also go. There have been a lot of ups and downs in the Indian pharma industry because of COVID and whatnot. So what we are seeing at the top level at a blended average is not a fair view to look at it. So I would still like to reserve the comment for another maybe quarter.
Okay. Thanks. That's it from me. Thank you.
Thank you. Our next question is from the line of Ranveer Singh from Sunidhi Securities. Please go ahead. Mr. Ranveer Singh, may we request you to unmute your line and go ahead with your question?
Hello. Yeah. Thanks for taking my question again. On R&D side, for fourth quarter, can you give some outlook? Because fourth quarter, a lot of filings would happen in US. So what would be the R&D expense?
It should be around just 1 minute. I think it would be around the same level, but could be slightly elevated because of the A&D filing costs which are going to come in.
Okay.
Yeah.
So full year should be in the range of 5 to 6%.
Full year we expect it to be around 6%. Around 6%. Yeah.
Okay. And secondly, on margin outlook, because the branded business is anyway going strongly, of course, and I assume that branded business, especially in India, has higher margin. So still the margin outlook for 9 months would be in that range going forward, or even for FY23. And even if we assume that price increase will also happen from April. So in that scenario also the margin would remain same, or we can expect some scope to improvement from here?
I don't think there will be any improvement because of the price increase of NLEM, etc. Because it is a small portfolio of 15%. So we need to see how the other portfolio behaves and how it will happen. But I think what we are talking about is a mixed basket. And mixed basket, definitely there is price erosion in US which we have to accept. There will be very less number of approvals which will be there. So all those aspects also will have the influence on the margin. So we are expecting this margin to be around that, sustainable.
Yeah, so just help me understand, currently we already, the raw material prices or other input prices have already increased.
Yes.
And even in that increased scenario, we are making the kind of EBITDA margin currently we have.
Yes.
So going forward, when we increase price of the final product, and obviously already input cost has increased and that is already reflected in EBITDA margin. So still we will not see any increase in EBITDA margin there?
Yeah, so I think it's very unpredictable. This global inflation, where does it stop? If it remains at the current level, or the US price erosion, as Arvind has said, how aggressive it goes into the next year, and how do we factor those two components in this thing? But as we said, there is always a 1% plus minus possibility does exist, depending on various combination of the product portfolio which we do next year.
Yeah. And sir, institutional business, this quarter has been, if you compare last, several quarters, has been lowest. So I believe that the lumpiness is there, but still can you give some ballpark annual number which we can expect? Or I can understand there would be some volatility there, but can we reach near about the annual performance we have in last or for last 2 years on an average basis?
No, it will not be there to the last year's level. So already in 9 months, we've seen there's a degrowth in the institution business, and quarter over quarter next quarter also there could be some degrowth there. So very difficult to put number on that.
Okay.
Yeah.
Okay. Thanks a lot, sir.
Yeah.
Thank you. A reminder to our participants, if you wish to ask a question, you may press star and 1. Our next question is from the line of Abdul Qadir Puranwala from Elara Capital. Please go ahead.
Yeah, hi, sir. Thanks for the follow-up. So just want to have your thoughts on so what could be the new geographies for growth? I mean, as we discussed earlier on the call, that the US is something where you're not comfortable allocating your capital, and on the branded generic side, due to the inflationary scenario, the margins are coming under pressure. So do you plan to diversify yourself within the geographies what you're currently, and if so, what would be the preferred location, where you will try to, or the preferred markets you would like to tap into?
No, I think probably we'll have to correct the perspective. We've said we are careful in making the capital allocation for the US. So that's what the US stands. AL business has already become 6-7% of the entire organization, which is the global this institution business. So moving the needle there doesn't really impact the whole organization performance on a whole year basis. So I think that is slowly, at one point in time, that was a very big part of the business for Ajanta. Slowly, other businesses became big, and this became smaller. So this became a much smaller component there. So actually, AL is not such a major. It's not going to be impacting the overall performance of the organization in a significant way. Other than these two, we've discussed that we are very bullish on the branded generic business, whether it is India or emerging markets. And that continues to remain to be the outlook, that those are the areas where maximum efforts are being put in. And those are going to be the verticals which will drive the growth of the organization in not only coming year, but years, like I would say.
Sure, sir. Got it. And just finally, would you still maintain your mid-teen growth outlook for the branded generic business?
Yeah, teens should be doable. I think probably somewhere low teens to mid-teens is the outlook we can, I think, look at. Yeah.
Okay, sure. Thank you, sir.
Thank you. As there are no further questions from the participants, I would now like to hand the conference back to Mr. Yogesh Agrawal for closing comments. Over to you, sir.
Thank you, everyone, for joining on to this call. And as there are no further questions, sorry?
If you have any further questions.
So if you have any more questions, you can reach out to our investor relations team, and look forward to seeing you in the next quarter call then. Thank you.
Okay. Thank you, everyone.
Management. Ladies and gentlemen, on behalf of Ajanta Pharma Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.